Yep, we're up.
All right, everybody. It is Thursday, 6/24/2020. So Leon and I are coming to you all live to talk about the power of dividends inside of your stock investments. So over the last couple of weeks, we've talked about a number of subjects, inequalities and the wealth gaps, 5G, stocks under $10, a number of other things. But throughout all those conversations, we've continuously made hints to the power of dividends. We've since had people sending us, messages, asking us like, what are dividends? How do they work? What's the benefit? What's the real benefit of them to me? So we decided to talk about it in depth. So if you have questions about dividends, this is going to be the time to ask us. If you have questions about, how to structure dividends inside of your investments, how to look to see if a stock is paying dividends, whatever it might be, please let us know what your questions are, and we'll be happy to get to them. If you're listening to us through the podcast, if you send us a message through the our email system, or comment below the running of this podcast, we'll be happy to get back to you as quickly as we can. With that being said, we want to thank everybody for being with us, and today's going to be a good one, especially when we start talking about the power of dividends, because we're talking about accumulation and compounded interest. So before we get started, quick shout out. Leon, who is it that said they are now watching us on television, on their television with their son?
Yeah, so spoke to Lynette earlier today. We were talking some business finance stuff, and she let me know, that she projects us up on her big screen during these lives. So Lynette, thank you very much.
Yeah, and I want to say thank you for letting your kids listen to this, because one of the things is we talk about the ROI gap, and that all centers around what our kids are learning and what our kids kind of walk into adulthood understanding, knowing, or their feelings towards money. So the fact that you actually watch us with your son is awesome. And we know it's a number of other people who start watching us or listening to us on podcasts with their kids. So with that being said, we thank all of you all for that. So Leon, if you can give them a little bit more about what we're talking about today.
Okay, one other shout I want to make out is to Cassie, who posted a mock-up link on her Facebook talking about the live tonight. So shout out to Cassie and Lynette tonight.
Yeah.
Okay, so tonight is one of my favorite subjects, which is dividend paying stocks. Brent and I always talk about how important they are and how powerful they are, but we actually want to put some numbers and kind of give us some examples tonight of the benefits of dividend stocks, and kind of want everyone to pay attention to this closely, because as Brent said earlier, we did 2 segments on the wealth gap, and then during the wealth gap we discovered something that we call the ROI gap. And the ROI gap is just how much white America is making on their investments versus Black America. Wealth gap can apply to anybody. It can be, of course, not all white America is doing as well as some of the portions of white America. So the wealth gap the ROI gap can apply to anybody. It just all depends on where you put your investments. So to close that gap, this is one of the easiest, and when I say easy, just easy from the standpoint of actually implementing it, easiest ways to actually close the wealth gap. Because you're going to see tonight how powerful dividends can be when they compound over time. So Brent, if you can put up slide 1 when you get a second.
And for those, while I'm pulling this up, I already know it's going to be a few questions on, what is a dividend? And so dividends change based off of the stock, but dividends essentially are the amount that the company decides to share with you from the profits of their actions throughout the course of the year. Dividends normally are paid out quarterly. So you get paid out dividends every 4 months in most cases. Dividends could be...
It's every 3 months, 4 times a year.
Sorry about that. Every 3 months, 4 times a year. And with that being said, it's normally pretty set. The dividend stays within like 1% range. However, it can change year to year. So, we oftentimes talk about the dividend being a great, powerful tool, but it does fluctuate. And please, some of you all, when we go through this, there are some companies that do dividend tricks. And so it's happened to a few of you all. Dividends are a very attractive tool in regards to bringing investors into the framework of a company or to buy their stock. So companies that pay really high dividends, like 14, 15, you might want to look at why they pay a dividend that high. It's great, sounds good in theory, but you want to know why and where they're getting the money from. Most of the time it's coming from profit. There are some companies out there, we like to think everybody's honest, but they're not. And they will actually borrow money and accrue debt in order to pay a higher dividend to attract more people to give them operating capital. Why they do that is to get money in the door. But that's not what we're talking about. We're talking overall dividends. But we know some of you all really went all in on dividends. So we want to make sure we say that before we pull up this screenshot.
Yeah, good point. So on that point, just in general, when you're looking for dividend stocks, typically dividends range from, as low as like, 0.05% on up to like 10%. Anything really over 10% as far as the dividend yield, you're getting into some issues there. Like you want to kind of do a little more research, see why that dividend is so high. Because on average, most dividends are typically going to be between 1% and like 6%. But there are some cases where you have 7, 8, 9%. 10%, you're kind of getting to a hairy area. Like Brent said, it could be because they're borrowing money. It could be because the stock price has tanked. So there are a lot of reasons behind that, but just be careful with stocks that pay high dividends and typically over, I'd say between 8 and 10%.
Yeah, and when you get to the 6 to 9%, you're normally looking at REITs. Sometimes, not all the time, but sometimes real estate investment trusts. They sometimes pay higher dividends just because of the structure of the companies, but still similar to what Leon said and what we warn against is when you start seeing 10, 15, 20, if you see 20, I'm calling it a company. Like I want to talk to somebody about why that is. With that being said, again, if you're listening to the podcast, we're actually pulling up a chart now, and it's a chart showing the returns of the S&P 500 index stocks by dividend policies. And so we're looking at the growth of $100 from 1972 to 2019. So for anybody who's listening to us, we will explain what we're going through as we talk.
Right. Yeah. So as Brent said, this is showing investing $100 in 1972 and how it grew through 2019. So the bottom half of the chart we're going to kind of ignore. Really, what you want to look at is from that number starting at $3,512, and we're going to go up from there. So with that's showing an investment, that $100 growing over this amount of time. The $100 growing from $100 to $3,512, just investing in stocks, no dividend stocks, right? Just regular stocks that do not pay a dividend. So over time, decent return. Now, if you go above that, you see that $6,607. That's investing in dividend stocks over the same time period. So you're seeing almost 100% increase in return just by investing in dividend stocks. And remember, investing in dividend stocks, there's nothing to it, right? It's just you buy a stock that pays a dividend versus buying a stock that doesn't pay a dividend. And you see that from this chart, doing that can get you almost 100% return, a little less than 100% return, just by having a good portion of your portfolio in dividend stocks.
Yeah, and while people are listening to us, you should know that accounts for a period of roughly 47 years. So the time frame we're looking at is over 47 years with $100 invested, one versus S&P 500 index, and then the highest number is we're looking at stocks that actually paid out dividends and they were growing.
Right. So the one above the $6,607, one above that now is $9,568. Now what that is, so above that is also dividend paying stocks, but the difference there is these are companies that raise their dividend at least once a year, right? So these are what they call dividend growers. And you see that from the dividend stock, the companies that just pay dividends to the companies that now increase their dividend at least once a year, looking at about another 50% increase. So again, if we go back to start at the beginning, if you just bought stocks without any dividend stocks, you made about $3,500, right? You bought dividends, you increased that about almost 100%. Then if you invest in stocks that only pay dividends, but then increased it at least once a year, you almost tripled your money from the beginning. So this shows the power of dividend stocks. And again, remember, you didn't do anything. There was no like legwork here. You just bought stocks, click of a button, bought stocks that pay dividend versus stocks that don't. And you can get anywhere from 100% return, almost 100% return, to almost 100. I think it was basically almost a 200% return if you invest in stocks that pay dividends that also increase their dividends at least once a year. Now with that, there's a group of stocks. There's a group of stocks that's called they're called the Dividend Aristocrats. And what this is, these are companies that have increased their dividend at least once a year for the past 25 years, right? Now, if you think about that, think about how powerful that is. So as Brent said earlier, dividends are paid from companies' corporate profits, right? So if a company can increase its dividends every year for the past 25 years, nonstop, right? Remember, they're cutting into their profits to pay that money out every quarter and every year. So they can do that every year for 25 years. That shows you how strong their balance sheet and shows how strong their revenue and profits are. That they're willing to do this and actually can do this and pay out more money to people like us who are shareholders. So companies that pay dividend are stronger than, or typically, let me say, on average, are stronger than companies that don't pay dividends. And then companies that increase their dividends at least once a year are even stronger than companies that just pay dividends. So companies that increase their dividends at least once a year, like I said, looking at the chart, you're getting almost a 200% return versus buying companies that don't pay any dividend at all.
I heard the catch, right? Like normally, and that's one of the things has to be like a consistent theme with everything Leon and I talk about. It's normally. And so when you do look at these companies, a lot of times people they used to say, I'm only buying blue chips because they pay dividends. When in actuality, not every blue chip pays a dividend. And so, there's certain themes about what's normal and what's not normal and what is and isn't. So also when you're buying dividend stocks, sometimes companies have two different types of shares. So if you are interested in dividend paying stocks and you are about to, listen to us, and again, never blindly just take someone's advice and jump in, make sure you're getting the right share of stock when you go to purchase it, if dividends are what you're after. And in most cases, when you go to a brokerage house or your brokerage account, you can actually see the dividend yield listed underneath the stock's ticker symbol. So be sure to read it to make sure you're getting the right thing.
Right. Yep. Are you go to slide 2? Yes. And what slide 2 is going to show you. So the biggest thing in investing, and this is what a lot of people don't often understand or get, the biggest thing about investing is managing your risk, right? So all everyone ever focuses on is how much money can I make? How much return can I get? And people don't often realize that the higher potential for return, which means also translates to a higher risk, right? And so great thing about dividends is that on average, dividend stocks actually are less risky than stocks that don't pay dividends. So look at this chart here. So just pay attention to the column that says returns on the left and the column that I've scratched out standard deviation, the one that says risk on the right. So underneath risk, it's in a percentage. So without going too technical, just know that the higher the percentage is under the risk column, the more risky the stock is, the more potential for loss in that stock. So under return,
just so for those of you all who are listening to our podcast right now, we're looking at a chart that shows the the average annual returns and volatility by dividend. So the time period is the same. We're looking at 47 years, and we're looking at companies' returns and then the beta for those companies. And we're really just focusing on showing the power of what returns can do. So just so you can kind of understand what you're listening to.
Right. So we're looking at risk versus reward, right? So again, the power of dividends. So the one I've kind of boxed off there in black is showing companies that grow their dividends per year on average, and then below that saying dividend payers, companies that just generally pay a dividend. They may not grow it per year, they may grow it some, but they pay a dividend. Now, if you look at returns, both those, so we'll just round up and say we're getting about 13% return per year. And on the right-hand side, you'll see about the risk is, we'll just say roughly 15.5%. So 13% return at a 15.5% risk, right? Okay, the one below that now that says no change in dividend policy. So these are companies that either don't pay a dividend at all or pay a dividend and don't raise it. They just kind of keep it as is. So those companies get about 11%, we'll say 12% return. And then the risk now has gone up from the ones above that, remember, we're about 15.5. These now are pushing about 18% risk. So what you're seeing here is you have your returns have gone down, but your risk has gone up. And remember, risk is potential of loss in trade or investment. So it's going the wrong way. You want things to go the opposite way. You want to have your returns. You want to have good returns with solid risk, or not too high of risk. What this is showing you is that the further you get away from companies that pay dividend, the less return you're getting and the higher the risk you are. Now, going one below that, companies that actually cut their dividends, their returns are about, we'll say about 11%. Sorry, my bad. Sorry, dividend non-payers. Sorry, dividend non-payers are about, let's say 9%. But look at the risk. The risk has now jumped to 24%, right? Remember, the higher the risk, the higher that number under risk is, the higher potential loss for the company. So we've seen about a 4 to 5% drop in return and let's say 10% jump in risk. So again, the further you get away from companies that pay dividends, the higher and higher your risk goes. Then you have ones that, go ahead.
So for anybody who's watching, listening, The way it plays out is essentially is the thought and the theory behind it is companies that normally pay not only a consistent dividend, but increase their dividend, they have a higher operating capital, which normally means they have higher profit margins. So they just tend to be more stable companies. To be as simple as possible, they have more money, and they actually have a better system, not better, time-tested systems that allow them to be more efficient in the way they run. Companies that don't pay dividends, they're not bad companies by default. So we want to be very clear about that. And it doesn't mean that every stock you get needs to pay a dividend, but we're just, because this is about the power of dividends, we're getting some comments about, oh, you know, like our dividends are the only stocks we should be looking at.
No, not saying it, not saying
it. And one question that came in from Malcolm is, what's the difference between risk and volatility? And I know you love talking about volatility, so I'll let you say
risk and volatility are the same thing, Malcolm. They're the same thing. That is a deep conversation, and
well, yeah, I was gonna say it's layers to it. So
there's many layers to volatility and risk. So that's why I try to keep
volatility and the type of risk. There are a lot of there's a lot of different types of risk. There's capital risk, governmental risk. There are just investing risk, loss risk. I mean, it's just so many types of risk, and volatility plays the same way. So implied volatility, are you looking at just the trading day, intraday trading volatility? So there's a lot of things to look at. So that's a question. Actually, that is a great question we can take to the group. So for anybody who's watching, they're like, yeah, I want to know the difference. And sometimes there's no difference, like what Leon said, but it just depends on what your definition, what you're looking at. So if anybody wants to go to Invest in Education Academy Facebook group, we can discuss it there. Mo, if you can repost that question there, we would appreciate it, and we would dive in today or tomorrow to kind of start talking about that.
Right, and I'll just say the simple answer to your question, Mo, is that risk and volatility are the same thing. There's nuances to it, but they're generally the same thing. So looking at this chart again, on the side that says risk, as that number goes higher from 17 to 24 to 24.3 to 24.8, the higher you go in risk, typically on average, the higher the volatility of that stock. So to answer your question, Mo, yes, volatility and risk are basically the same thing. So back to the chart now. So as I said, dividend that companies that don't pay dividend at all, talking about a 9% return.
Lee, let's talk about that. So I think it's more accurate to say that risk and volatility are directly influence one another.
Well, I would say in the context of this chart, they're the same.
Okay, this chart, yeah. Okay.
Yeah. In the context of there's, like you said, there's tons of risk.
Yeah.
But in the context of this chart, risk and volatility are the same thing. Yes. So again, non-dividend non-payers, 9% return, 24% risk. So as I said, again, as your return kind of goes lower, your risk goes higher. Then one below that is dividend cutters, or companies that pay a dividend then eliminate them. The return is a little bit higher, but again, the risk is still about 24%. And then below that is the S&P 500, which kind of aligns up with the returns of dividend payers, which is about 12% return and then 17% risk, kind of in the range of dividend payers. So basically what this is showing, and what I want to point out, is that on average, again, individual stocks are different. You know, each stock has their own pluses and minuses, but on average, the more dividend stocks you buy, the less volatile your account or your portfolio will tend to be, and you'll tend to get higher returns. And the reason that is, again, on average, is that, you remember, if you have stock A and stock B, if stock A is up 10% in a year but pays no dividend, but stock B is up 10% a year but also pays a 3% dividend, at the end of the year, stock A is going to have a 10% return. Stock B is going to have a 13% return because it was up 10% for the year from the stock appreciation, but then 3% more for the dividend. So this is why dividend paying stocks on average return more than non-dividend paying stocks. As Brent said, not saying only buy dividend stocks. We're just pointing out that this is the way to try to increase your returns in your portfolio. And this, like I said, this is a really good way to kind of close that ROI gap, because again, it's an inexpensive and relatively easy way to boost returns without taking on added risk. You can actually reduce risk by doing this strategy than add risk.
Yeah, and Salma, you asked the question, how do we know the different types of risk for each company? It varies. It depends on the company. So It can be industry risk. It can be company specific risk. It just depends, because you have, like, if you were to take, not too long, we talked about the marijuana industry, right? That's a governmental and regulatory risk. So governmental and regulatory means that depending on what the regulations are that, really come out about marijuana per state, it could affect different companies different way. You may have competitive risk, and it just, if a company's coming out in a very competitive industry, their risk could be, it's so many types of risk. So to answer the question, Salma, and since you're an attorney, you can appreciate this, it depends. So it really depends on the company, depends on what their growth model is, and really the business model as a whole, because different things can affect them. Elections could affect them, inflationary risk, it just truly depends.
Right, and Brent's exactly right. The risk, but again, the risk for this chart is primarily talking about volatility. And when I say volatility, I just mean how volatile the stock is day to day. So, you may be up $3 today, down $4 tomorrow in one stock. One stock may only move 50 cents per day. The stock that moves $2 or $3 is more volatile than the stock that only moves 50 cents. So this is talking about volatility. This is talking about the day-to-day movement of the stock when we're talking about risk.
Yeah, and this is like the perfect plug for Leon's famous word. So when we were talking about this, I can see from some of the people who are sending me direct messages and some of the people who are putting comments up, their risk is like that term that causes a little bit of tension, anxiety. So one of the things that should ease that is the fact that we always talk about using a certain type of money. It's just like the drum roll. And Leon, that type of money is what?
That type of money is risk capital.
Why should people use risk capital when investing?
Because risk capital is money that you can lose. It's money that you're not using to buy groceries, you're not using to buy medication, you're not sending your children to college with. It's money that you can physically and actually lose. And if you lost it tomorrow, life would go on. That's risk capital.
And for the young people who are watching this, which I'm so happy you all are watching this now, risk capital to you all may be birthday money or Christmas money. It's money you otherwise wouldn't have had. And in most cases, not all, in most cases, you're not depending on that money for life. And so risk capital to the group, I would say 15 and under, 16 and under, is really like birthday, Christmas money. If you're working a job, there's a large percentage of your check that could also fit into that risk capital framework. But that's something we can, if you want to have your kids come into the Investment Education Academy group and we start talking about that, we'd be happy to do that. And I'm really proud of you all for watching this and listening to this.
Definitely. Yep. All right. So you throw up slide 3. So slide 3 is going to show you. So what this is showing you. So this is laying out the corporate profits that companies have been accumulating since 1945. Right. This is how much money they have on their balance sheet, how much money they have in the bank. And remember, as Brent said earlier, corporate dividends are paid from corporate profits. Right. So as we can see, since 1945, corporate profits have exploded. I mean, gone from essentially zero to, we're talking 2.5, pushing like $3 billion. I mean, this is on average. This companies have higher, companies more and less, but this is on average.
And real quick, just for those who are listening to the podcast, we're looking at a chart that shows record levels of cash on corporate balance sheets, and we're looking at 1945 to 2019. So you're talking about roughly like 70 some years. So we're looking at a bar graph that shows the increase. I'm talking like an explosion of cash in corporate balance sheets from 1945 to 2019.
And you see on this, so from about 1975, 1980, 85 is where the curve really took off. And so one thing you also notice is that, and I don't have it here, but dividend payouts are starting to increase with this chart, right? So what this is saying is that companies that are paying dividends now will most likely continue to pay dividends and actually may increase their dividends per year because their balance sheet and how much cash they have on the balance sheet is so strong and it's so big. And companies that aren't paying dividends currently are most likely in the future to pay a dividend because, again, their balance sheets where they have their cash from this chart, it has, as Brent said, has exploded. So, so dividends in the future are one pretty safe, again, depending on the industry and company, but and the balance sheet, how much cash they have, are pretty safe investments. As Brent said, they can change. Companies can cut their dividend. And as like, for example, right now, a lot of the airlines have cut their dividends to zero. And a lot of the cruise lines have cut their dividends to zero. Sometimes they'll cut them by a percentage, But right now, a lot of companies have cut them to zero because we're dealing with COVID, and this is just a unique time. But just know that going in, when you get into a stock that does pay a dividend, as Brent said earlier, it can change. But if you're looking at companies that have paid dividends, over, like I said, those dividend aristocrats that have paid dividends, have increased their dividends at least once a year for the past 25 years, it's highly likely that they will not cut their dividends, that they will continue to increase them.
And
so,
real quickly, I just want to make sure we show this while you're still talking about it. For anybody who's listening, I just went back to the previous chart, and there's actually a heading for dividend cutters and eliminators, and that wouldn't exist unless there were companies that cut their dividends or eliminate their dividends. Let's talk about why that happens. Cash on the balance sheet is exactly that. Balance sheet is a snapshot in time for that company. Times change. And when you have a COVID situation, or you have this, balance sheets aren't perpetual. So it's not like they have a balance sheet that's very strong today, which means they'll always have a strong balance sheet. You take American Airlines, for instance, and them having to cut their dividends. It's because they're now allocating what was that money they were paying out to stockholders to just maintain the business. It could be normal business overhead expense. It can be payroll, which payroll is a normal business overhead expense, but they're just paying normal day-to-day costs. In addition to that, now they're probably using it to pay for extra costs like new cleanings, new types of services, things they never anticipated. So the reason why we want to talk about that is that if it's a company that's not paying dividends and COVID hits, they can easily get eliminated. When it's a company that has a strong dividend going into COVID, they can do some, rearranging of funding to make sure that they have enough to pay for normal operating expense, which saves the business, although it may hurt your dividend, but you still own the stock. And you can, again, time. We always talk about time. If you are in with the stock or invested throughout that period, when the stock comes back, they tend to come back stronger. So just know these things happen. It's normal part of business for just unusual things, unusual as usual, over some period of time when you're with a strong company.
Yeah, and an example you gave about American Airlines, so I'll just piggyback on that. They're burning, as of right now, they're burning $50 million a month. I'm gonna say that again. American Airlines is burning $50 million a month with essentially no revenue coming in. So as Brent said, they were paying a dividend before, and I don't know how much it was, but they were paying a dividend before, and it's typically billions of dollars a year. So by them cutting that dividend to zero and keeping that money in house, it's almost like they self-funded themselves. They took that money that was going out the door and brought it back in house, and it allows them to kind of weather the storm of burning that $50 billion a month. So yeah, companies that pay dividends on average are a lot stronger than companies that don't. And as Brent said, it's kind of a good example that a company that does pay a dividend, they can cut that dividend and help their business out in times like this with COVID, where a company that's not paying a dividend at all would be in more trouble because they wouldn't be able to access that dividend money, like in American Airlines. So yeah, dividend paying companies are my favorite personally. And like I always say, they provide a returns boost and a loss cushion.
I like that.
You like that? You like that?
I like that. That was good.
Quick example is like I gave before is that if the stock goes up 10% a year, if the company's paying 3% dividend, you're actually going to make, instead of making 10%, you're going to make 13% because of that dividend. If the company pays 3% dividend per year, stock drops, say 5% that year, you've actually only lost 2% because you're going to get that 3% dividend. So dividends are very, very powerful in padding gains and reducing losses.
Yeah. And in general, when you guys are out, when you hear us, and you're like, oh, okay, this is cool. I'm gonna start looking for dividend paying investments. That's great. We love to hear that. But the same token, still make sure it's a strong company. I think 3 weeks ago we showed you a company in my portfolio that went to zero. So actually they didn't go to
No. They went below a penny.
Below a penny. It was like 0.09%. But and that's going to take me down the road, but so I'm self-regulate. So essentially, I want to say that one of the other companies that I did not show, which actually I might show when we open up the membership, I'm going to show you guys this other company. They were a real estate investment trust. They were paying a consistent dividend of 9%. They were borrowing money to pay the dividend from banking institutions and other investors to pay this high dividend. Of course, none of the investors, well, stockholders knew. All of a sudden, they risked being delisted. And in an attempt to save themselves from being delisted, they did a reverse stock split and got their per share price high enough where the exchange would keep them listed. And then they changed the name of the company. And so it's just, we're saying this to say, it's no, you never want to just go in blindly. Right. Still make sure the company is viable. They have a track record, and check up on them too. You know, we're time investors in this framework, but both Leon and I, we played the market where not every investment was going to be held for 20 years or 10 years or 5 years. So you want to check back in on those stocks every now and then just to see, has management changed? Because I can tell you now, companies like Tesla, those are companies that are very heavily driven by the CEOs. And so if something happens with those CEOs, it can drastically affect the stocks. So every now and then you want to check back on the stock just to see, is management the same? Read your prospectus. You know, you receive information when you're a stockholder that really tells you the health of the company. And it comes in the form of prospectus. Normally it's emailed to you. These days, they actually used to send out prospectuses with like Bible thin paper. And we used to call it sleep material because it would normally, right. But the point is, be sure to check on the companies, no matter who you are or how savvy you think you are. And these get rich quick people out here who are like, oh, give me $50 and I'll get you back 1,000 tomorrow. It's like, that's not the way dividends work. Right. So we're showing you time-tested ways to make money in a reasonably secure environment. But bottom line is this: if you're looking at banks versus a dividend-paying stock, so what are your thoughts on that, Leon?
What do you mean?
Like, would you pick a bank account or a dividend-paying stock?
Oh, you mean bank account? Oh, dude, come on. Bank accounts in my mind don't even exist anymore. So, I mean, I'm not saying they don't follow me, but I don't do the savings account at all. It's, to me, as we've said many times, you're losing money every day if all your money is sitting in a savings account that's paying you less than inflation. Inflation on average is about 2-3% per year. So unless your savings account is earning you 2-3% per year, you're losing money every day. So for me, bank accounts don't even exist.
I see them as a transition spot to get my money to my investment. And actually, it's not even in a savings account; it's in a checking account. But you know,
yeah, I have checking. I do not have savings though.
And for my daughters, I did do savings just to move money through because they didn't need a checking account. So, right. You know, for children, I say this as a parent. I have 2 girls, 7 and 4. For anybody listening, really think about what you're doing with their Christmas and birthday money. Like, you know, and for these kids, and this is a quick story because it really got to me and it burned me up. I had a friend and business colleague, and he came to the office for a meeting, and it was right around the time report cards were sent out. And forgive me if you're listening to this and you know it's you, but I won't use any names. So he said to me, he was like, oh, my daughter killed it this semester in school. She might have been 9 years old, 8 years old. She got all A's. I was like, oh, that's what's up. That's great. And he was like, yeah. So I took her out to get some shoes. And he was like, she's been eyeballing these shoes for quite some time. So I let her buy them. And I was quiet. You know, it was dead air, pregnant pause. And he was like, yo, don't you think that's pretty cool? I was like, you know, I'm trying to stay cool about it. I said, but I can't understand why your reward to your daughter is teaching her to be a consumer. Mm-hmm. So you're telling me that when she does well in school, you're teaching her to give other people her money? And I was like, it's not even her money, actually. You're teaching her to give other people your money.
Right, so, yeah, right, because he paid her.
So, yeah, so I was like, your reward to your kids is teaching them to be a consumer. I was like, bro, I can't subscribe to that. And he was like, we were friends. It wasn't, but I refused to be the cheerleader for the fact of being the cheerleader. Yeah. Like it's hurting us. Like right. When we do things like this, it hurts us. You look at these dividend paying stocks. Go buy her some stock and let her be able to buy her first house with the money that she's accruing inside that dividend, that stock, that dividend.
Or at least if you're going to buy the shoes, also buy her, like teach her about the stock too. Put some money in the stock. Don't just buy shoes and let her know that you're also doing something that's also, you know, helping her accrue wealth and not just being a consumer.
Yeah, and have that conversation. Don't have a conversation about, oh,
Go buy shoes. Yeah.
So anyway, I'm with my kids now, not even now, since they were like 2. When something good happens, I say, oh, you know what, you did well in this. What you can do is actually go see how much money you have in the account and see what stock you want to buy. Like, I make that the reward. And I'm like, oh, you did great. I was like, oh, you did really good report card, sweetheart. Let's go see what stock you can buy as a reward to yourself, a reward to yourself.
Right. Pay yourself first. Right.
Yeah. And so now, you know, my 7-year-old is teaching my 4-year-old, like, she went to go buy some like bubble gum one day at the store. And she was like, we don't own the stock of that company. You can't get the bubble gum. And it might have been extreme, but at the same time, it showed me that the 7-year-old has the concept. And not only that, but now she's teaching the 4-year-old, that's not how we move. That's not how our family moves. And that's what's going to create a change in our generational wealth, is changing the mindset of our kids. So if you all are watching, we just gave you the information on how these dividend stocks grow. And really the compounded effect we didn't even show, but the compounded effect is a whole nother, you know, thing that we can touch on when it comes to dividend paying stocks, especially when you start looking at dividend reinvestment plans. They're called DRIPs.
Right.
But some people use DRIPs, and Leon and I touched on this last week. Some people use DRIPs for reinvestment in the same company. Other people use DRIPs to go buy other assets. Even if you use dividend money to go buy a car or to get something you wanted, at least you're using the interest on money that's still working for you.
Right. And remember that's money. That's money that the company is directly paying you. It's almost like being an adult and still getting Christmas money from your parents or something. It's money that you didn't do anything for, that is being put in your pocket for simply owning stock. I don't want to say it's free money, because Brent gets money when I say free. Nothing's free. I get it, but it's money that you did nothing for. It's
okay. We can say it like this, Leon. It's your reward. It's your monetary reward for opportunity cost, where you decided to use the money to invest in that company. That company's then saying thank you for giving them or letting them use your money, because they are using your money. They're using your money to continue to grow. They're using your money to pay for marketing. They're using your money to pay employees. They are using your money, and that is the thank you for it.
Right. You're actually getting a return on that money you put into that company, purely out of the profit, not just the appreciation of the stock, purely out of the profits you're being paid too. So you know, you got to think of it like that. That's money as an adult that you're getting for essentially not really doing anything. So I don't know how anybody can't make dividend stocks a large portion of your. I mean, we just showed you dividend stocks that companies that not only pay dividends but increase their dividends per year. You're getting almost 200% more return than on companies that don't pay dividends. So it's a no-brainer to have a large percentage of your portfolio to be in dividend paying stocks.
Yeah. So with that being said, I mean, I just caution those who, you know, reward their kids with like ice cream or going shopping at a mall. You know,
let's break that cycle. And like I said, and there's nothing wrong with rewarding your kids, but also have a second portion of that be, you know, teach them about finance, teach them about wealth, teach them about assets. Like Brent said, buy them a dividend paying stock. Let part of the reward be that they go buy another dividend paying stock.
Yeah, or go exercise. Like, oh, you know, you did great. Let's go.
Something that you're not just being a consumer.
Yeah, like something that's going to improve their life.
Right.
And so, you know, we got to break the cycle, and we're going to talk about that a lot. It's not going to be the main point, but especially for me, I see it. And you know, when I was a financial advisor, I saw it so much where families would skimp on investing or insurance, but then they would go buy these really expensive cars or a house that they were mortgage poor, or they would then just go shop and they had all the bags in the world, or, you know, the clothes, but they had no wealth. And it was so disappointing. So I mean, when we bring this information, just understand this is just passion. It's like we have to change. We have to change.
Right. And just last point, touching on the ROI gap. So as I was saying, as we talked about in the previous video, how we were saying that has to, you know, right now the ROI gap between white America and Black America, white America makes on average 139% more than Black America. So whether you're Black, white, whatever, Hispanic, you know, whatever, just know that, as we showed in that chart, and maybe go back and watch, you didn't see it, that you're getting almost a 200% more return by investing in stocks that not only pay a dividend, but then raise their dividend at least once a year. 200% more return versus investing in stocks that do not pay a dividend at all. So that's one very simple, very easy way to decrease that ROI gap. And yeah, that's set on that.
All right.
So, bro, what you guys for?
We owe you all what we owe you all, and that will be our stock picks for today. I'll go first. I chose Square, ticker symbol SQ. So for those of you who don't know, Square is a financial services company. It's like merchant services. Essentially, they do a lot with mobile payments. Many of you all have seen the little Square. It's a little box. You go to a trade show, you go to a restaurant, and sometimes they'll just swipe your card. And a lot of times they use Square. Square was one of the first ones to establish a name for itself in the industry of mobile payments. I really like Square, especially as the marketplace moves to pretty much everything being digital. Even a result of COVID is the fact that there's a large population of people that don't want to touch cash. Literally, they do not just want to physically touch the money. And so you think about what's happening in our economies. Our economy is moving faster. Things are becoming digital. And not everybody's going to, of course, trade Bitcoin. So companies like Square, I think, are perfectly placed. And then you get this millennial rush of people using Cash App. And between a conversation with Leon and I recently, I found out that Square owned Cash App. Had no idea. And so that's what put me over the top with Square. And Cash App having its brokerage services, Bitcoin, credit cards. Cash App is really, truly establishing themselves as a financial institution quietly, like loud but quietly. Like, I think a lot of people think it's just a really cool app, but on the back end, the infrastructure of the company is building very strongly. And for that reason, I decided to pick Square. I think the future of the company is strong. Right now, they're roughly around their 52-week high. So they're trading at $100. The 52-week high is 106. Oh, it's actually on the chart. Let's read the chart. It's at 106. And some people, again, we talk about those that try to find value investing. Nothing wrong with value investing. However, it doesn't always have to be the value that we are normally used to. Companies can be at or above their 52-week high and still be a value play, because we don't know what they'll be in 3 years, in 2 years. And you have to think, any company, those companies that we just talked about that are dividend paying companies, I would venture to say, without even seeing their charts, if you looked at them, they continuously test their 52-week high on an ongoing basis, maybe 3 or 4, 5 times a year, because companies that grow, of course, have to break their 52-week high. So when Amazon was $3.19, that was a test of its 52-week high at the time. When it went up to $100, that was a test at its 52-week high. So just think about the potential of these companies, and not just, oh, it said it's 52-week high. It's too much, because that's not accurate.
Right. Yeah, not at all. Yeah, I mean, 52-week high, by definition, it's going to be broken at some point. So, all right. So my pick is automated data processing, ticker symbol ADP. Today they closed at $144.84, and they were down 3.77%. So ADP is one of the largest human resources companies in the United States. Not a sexy name, not a name you're going to hear a lot about. But
entrepreneurs know ADP.
I'll say it's one of those companies that behind the scenes is absolutely killing it. Everyone that has a job out here probably interacts with ADP on some level, because again, their systems are, a lot of their systems are what a lot of companies use for their human resources systems behind the scenes. So many large companies use ADP. Some of you may hear on, I think it's a day. So the job, I may be going to the weeds here, but the first Friday of every the jobs report comes out, right? The day before that is what's called the ADP job report comes out. So ADP has their own jobs report. Then you have the job report from the federal government. So that's how big ADP is. ADP actually goes out here and puts out a report based on how many jobs are gained or lost in the economy. So very, very, very strong, very, very robust company. Like I said, behind the scenes, not sexy, but grows steady. So its 2-year profit growth is a healthy 21%. And its 2-year sales growth is roughly 6.4% on average over 2 years. And since we're talking about dividends, today it pays a 2.5% dividend yield. So very, very, I mean, I always say you look for dividend yield that's above inflation, that's average 2 to 3%. This at 2.5 meets that criteria. So I picked ADP.
Yep. And for those of you all who don't know ADP, again, if you are an entrepreneur, you more than likely know the name. For those of you who don't, and depend on me and Leon to bring you just as much information as we can, one of the other reasons why I also like ADP is they are a very smart company. And a lot of times you'll hear me talk about the qualitative side of companies, and this is no different. As they grew on the paycheck processing side of the business, they realized that they were engaging so many of these small businesses that had no idea how to run their HR departments. Where ADP used to support an organization called Helios, which HR. Well, actually, I'm about to get total history, but they used to support.
You better go ahead.
Yeah, I'll pull back. But long story short, as they saw gaps in the system and what's called vertical integration, where they can just stack these services on top of what an already existing business model was, they did so. And they're even now, or they might have already done it, where they're moving into retirement planning, 401ks, 403bs, 457 plans, TSPs, things of that nature. That's going to bring a whole nother segment of money into them because they're already processing the checks for payroll anyway. And for most small businesses, they're providing back office service, which means now an entrepreneur or a solopreneur gets an HR department. They get a retirement investing, like investor relations department, and they still have payroll met, and they have some type of legal assistance from ADP because HR oftentimes becomes a legal issue. So for that reason, and that's very qualitative, but just to tell you just the basics on looking just how a company moves, I really like the way ADP services the marketplace.
Yep, hold up. Yep. Like I said, behind the scenes, not sexy, but it's a steady winner.
I used to do payroll through ADP, full disclosure.
Nice. You validated my choice.
Yeah, and I'm good. So with that being said, we thank everybody for listening, sticking with us, and the numbers have been steadily going up as the time goes on. So we know that you all are sharing this, but next week we're going to be kind of moving in a different space. We're growing. So AEI is growing. We have been working diligently behind the scenes, and you all will see much of that work come next week. So we are excited to just kind of make a teaser announcement that the growth is coming. If there's some issues, just call us and tell us. I understand where we too are a new company. So thank you all. The support has been great. Leon, do you have anything you want to say?
Just to recap, dividend stocks are a relatively easy way to grow your portfolio. Like I said, it pads gains and cushions losses. And there's no more exercise, there's no more effort in buying dividend stocks versus non-dividend stocks. Just clicking the button. Not saying only dividend stocks, but you want it to be a large portion of your portfolio.
Yeah. And for anybody who wants to, the conversation we talked about moving over to Invest in Education Academy Facebook group, we're going to check it out tonight. If you want to post additional questions, if we didn't get to your question, we apologize. If you listen to the podcast, you too can go over to Invest in Education Academy Facebook group and join and get involved in the community and exchange thoughts, exchange ideas about different stocks. We're going to be announcing some new stuff happening inside the Facebook group as well next week. So just definitely tune in, have a friend tune in, and thank you for bringing your family to us and trusting us to deliver this information to you. Have a good day.